Hey, so welcome to another episode on Hungry for Returns. I normally always have to put something here to support the camera, just because I don't have an exact stand custom made, right? I want to thank you so much for joining me in today's episode. We're going to take a look at the delta today from a visitor's question. If you have a specific question you want me to answer regarding stock trading, investing, option trading, then go ahead, submit a question by writing it in, or you can submit one by voice and you might get featured on the show. This is just based on my own personal knowledge, history, some successes, and some really bad failures as well. So I'll give you my insight and try and make it as detailed as possible. So go ahead, submit one if you have one. If you don't have one, well, just listen up and learn something. So let's take a listen to today's question, and then we'll go ahead and answer it on screen.
Hey Sasha, good evening. I just want to know that what are 16 delta, 20 delta and 25 delta. I have heard that people discussing on that do 16 delta strangle, some say 20 delta strangle is good, some say 25 delta strangle is good. So what is the exact criteria of selecting the delta values, and what you think is better for writer from option writer's point of view? And also I want to know how volatility impacts calls and puts. Thanks.
Okay, so we're going to skip the volatility effects, calls and puts. That's kind of two questions. Might put it into another episode here coming up. But let's take a look at 16 delta, 20 delta, 25 delta. Which one's better? You know, people always ask, is this better? Is that better? Really, it's not that one's better than the other. It's just they have advantages and disadvantages. And it's kind of like, hey, what's better? Is a Toyota Camry better than a Toyota Sienna? One's a van, one's a four-door sedan. Is a Prius better than a big truck? One's more economical on fuel, the other one can carry a whole bunch of lumber to fix your house. So it's not that one is better than the other, it's what are the advantages and what are the disadvantages. So let's take a look here. If we go on screen, this is a Thinkorswim platform. And the way you look at the delta is you change kind of these option instruments. So what we'll do is we'll go ahead and find the delta first, and we'll look at it right here. I'm also going to go ahead and change the other one to option probability of in the money. And what I want you to really understand here is delta refers to a few different things. Delta number one, look how close it is to the probability of in the money. Okay, so delta, you could say, is very close to probability of in the money. So here we have a negative 0.46 delta, but we also have a 49.82% probability that this will be in the money at expiration. Here, if you look at the 1550 on Amazon, you can see we have a negative 0.29 delta, but roughly about a 31.77% probability in the money. And you can see they're all very close, within a couple, tenths of a percentage point there. So very, very close if you really look at it. And if you go to the 1400, let's say negative 0.07 delta, is really about, I would say, 7% probability in the money. But really, if you look at those percentages exact, it'll be 8.80 at this exact time. Now, what I also want you to understand is delta refers to the movement for the dollar value, right? So if I go ahead and buy this single and I analyze this trade, okay, so take a look. This delta right here is negative 0.977, right? 1430. This is the 1430, and if we go 1430, you have a delta of about negative 0.10. Okay, whereas here, if you want to get the exact one, it's going to be negative 0.972. Okay, again, bid-ask spread, a little bit difference there. So it refers to not only the movement of that individual contract, but also it refers to that probability in the money. So it refers to a few different things, right? Now, which one is better? Well, remember, this is probability in the money. So if you're an option seller, right? If we're selling options, well, our 26 delta is closer. That means our chance of success is less, but we make more money. So it's a trade-off. So let's say we're talking about a strangle here, and we'll compare the 25 delta to maybe a 15 delta. So here, we'll go to about a 26 delta. That's pretty close. So we'll go ahead and sell a strangle, okay? So there's the 1550 is about 20.28, so about 29%. And we'll do the same thing here on the other one, the call side. Okay, so we'll do about the 26 delta, 1730 on the calls. Okay, so 1730, and I'll analyze the trade for you. Okay, so is this one really good or is it really bad? Again, it really just depends. Pros and cons. What's the advantage of this? Well, the advantage of this is you get a whole bunch more premium to your trade. Okay, you get a lot of premium, a lot of room right here. The disadvantage is that you're tighter. Okay, so you can see you're tighter, right? You're in tighter than you would at a wider delta. So let's compare this to another trade. Okay, so here your max profit is 4655. Okay, let's compare this to maybe a 16 delta or a 10 delta. Okay, here's about a 10 delta, 1430. Let's do the same thing. Sell a strangle. Okay, 1430. And then let's do a 10 delta over there. Do about a 1830. Okay. So here, if we go to the 1830 on the call side, and we have the 1430 on the put side, both at about a 10 delta, watch the difference. You're wider. Okay, so you make only 1,412, but your chance of success is greater, right? Because you're wider. You're basically going from a 1430, okay, whereas the other one is a 1530. So you're 100 points wider on both sides. So your chance of success is greater, but you make less money on probably about the same amount of capital, give or take. So, you know, one is about 16,243 buying power effect. The other one is 24,000. So similar capital, but the other one you make almost, let's see, what is it? 4,600. This one you make about 1,400. So about 3.5 times or so more for almost similar capital, but you know, a little bit different, of course, just because the ranges. Now, normally I wouldn't recommend a trade like this. I would say, hey, you still should buy some wings out for protection. Do like an iron condor, so that way you're risking less. So you cap it off right here. And the way that that would look is, let me just put that trade on for you so you can see. So let's say you go to kind of a 15 delta. We sell an iron condor. So here we go 1,500, and let's just say we do 1,500 on the puts. Okay, so we sell the 1,500 on the puts. We buy the 1,470, so 30 points out. And let's say the call side, we do about a 15 delta, which will be about 1,790 on the calls that we sell. 1,790, also about a 15 delta that we sell, and we buy the 1,820. We'll go about 30 points, and we'll analyze this trade. Uses a lot less capital, okay? And you can see you limit your risk. So you make about 780 on $2,200 worth of risk. And I see that on this bottom part or area. So that's the way that you take a look at it, and how you structure this trade. And that's the smarter approach, is when you do something like this, it's a lot better than just going out and selling kind of a strangle. You just go ahead, cap it off there on the ends, and now you've limited your risk. So really all that happens is that when you have a bigger delta, this will come in a little bit, but you make more money. If you have less delta, well, you make less money. You know, you're going wider. You're basically just widening it out. If you're at a 16 delta or a 10 delta, you're going wider than a 25 delta. You're bringing things in tighter and you make more money. But the disadvantage is the bigger that delta, because you make more money, well, they're not just going to give it to you. Instead, what happens is your chance of success is less because you have the chance of making more money. So which one is better? Well, it depends. If you're brand new, go as wide as you feel comfortable, and slowly you can bring those things in. If you're more experienced and you know how to manage the trade, you can go a little tighter, which means you can make more money, but you might need to manage or play with the trade a little more. So I hope that makes a little bit of sense for you on what kind of to do as far as selecting the delta within, whether you're doing a strangle, whether you're doing an iron condor. That's really the way that it works and functions. All right, so thank you so much for joining me in this week's episode. Hope you found it helpful, you learned something, and continue to improve yourself as the week moves forward. So thanks again, and don't forget to get on the newsletter list so that way you know when my next book is coming out, other free training, and of course, great courses. And you can do so by going to the website at tradersfly.com or clicking a link in the description below. Thanks again, and I'll see you next time.